ladies and gentlemen. Welcome back to another Livewire webinar. My name is Bella Kidman and I'm one of the content editors here at Livewire. Today we're going to be chatting all about the end of financial year, getting your portfolio into shape. And of course, I'm joined by my guest today, James Gerrish, author of Market Matters. James, thanks for being here today. Great time to chat.
Bella, thanks for having me, and thanks to all the listeners out there who's giving us some time on a Tuesday lunchtime, I should say.
Yeah, I'd just like to echo that. Thanks very much to everybody for tuning in. We understand it's a pretty hard time for some people at the moment, so we really appreciate you taking the time out of your day. So let's get started. I'll just pull up this disclaimer here. Please make sure you read that. That's very important. I'll just leave that on the screen for a few seconds while everybody gets to read that. And then I'll just give a quick overview of our agenda today. So we'll be chatting about rebalancing your portfolio for the beginning of the financial year. I'll then pick James's brain on some growth stocks and high risk ideas. Then we'll probably counteract that a little bit and talk about some defensive companies and where they should sit in your portfolio, particularly considering the current market. And then we'll try and answer the $1 million question about when to sell a stock, particularly at this time of the year. So that should take about half an hour. And then we'll open up the forum and let you send through some questions that you want James to answer. And we're going to get through as many questions as possible. But in the event that we run out of time, we've turned on the upvote function on Zoom. So what that means is at the bottom of your screen, you should see a Q&A tab. And if you open that tab up and see a question that somebody else has submitted that you really like, you can vote for it so that we ask the questions that the most people want to hear about. So James, I'm very excited to get into the questions that we've prepared for you today. So remember, everybody at home, send through those questions and utilize that upvote function. So first up, we'll look at rebalancing your portfolio for the new financial year. And James, I've asked you to do a little bit of homework for our viewers and talk about perhaps an end of financial year checklist. So I've put that up on the screen. So maybe can we start off by you just giving us some ideas about what this checklist entails?
Yeah, we'll go through the checklist, and then I'd love to get into showing viewers some live charts around how we think about markets. And I'm sure we're going to get there, Bella. But I think, to me, there's a lot of talk about the end of financial year and what you need to do across your portfolios. And I think you can probably break it down into a couple of key areas. So there's the way I think about it is sort of the practical things you need to look at for your portfolio. So that's largely around tax. So looking at your portfolio position, looking at from a broader sense from a tax position. So that's obviously talking to your accountant around that, looking at the accrued capital gains. And these might seem, pretty straightforward things, but looking at the accrued capital gains in your portfolio that have accrued over the last 12 months and potentially offsetting with some losses. You don't want to be donating more to the ATO than you really need to. And then the third thing is around sort of paying forward costs. After a really strong year in markets, it's very rare that you won't have capital gains in your portfolio. So you can pay forward costs. So, for me, I pay forward margin loan, interest, etc., to get that cost into this financial year. So obviously, that's something that investors should consider with their accountant and seek advice around that. But that's an aspect you can look at in your portfolio. I think positioning is really important. So, I think this webinar is all around sort of getting your portfolio into gear. And I think asset allocation is a really important thing around that. So the way we run portfolios is having asset allocation targets. So at the end of financial year and continuously throughout the year, we're looking at our asset allocation targets and seeing that their investments fit into our asset allocation targets. They're not hard and fast targets. They're more of a band of where we want to be positioned around asset classes at this particular point in time. And then if a few more practical things, stocks that have been sold down throughout the year and have got big capital losses in them often continue to be weak going into June 30. And that's particularly relevant in a market that's been really strong over the period. So there's very few stocks, particularly in the top 200, that are down materially during the year. So selling those stocks into June 30 typically makes some sense. And if selling a stock in that sort of area, it's probably too late now, but you probably get in earlier. If you're buying a stock that has been weak over the last 12 months, then you're probably leaving it towards the, near enough to June 30 to go in and buy that. I've titled the third point around reflection. It's just a line in the sand at the end of the financial year. So it can often be a point of thinking about what I did right during the year, what I did wrong, what I could do better going into the next financial year, and about setting goals around what you're wanting to achieve, and more so around how you're approaching the market. So I'm big on the process around approaching markets and what we do on a daily basis to keep our fingers well and truly on the pulse. That's what I concentrate on most, is around improving the process. And then I'd probably highlight the warning is that don't let tax decisions dictate investment decisions. Obviously they influence it, and that's something we need to consider, but don't let that be your number one priority. Always think about, we should be focusing on portfolio performance, and that's the core of what sort of we do on a daily basis. So thinking about performance rather than paying a little bit more tax, etc., to sell a stock that looks like it's about to decline materially, but you don't want to incur the capital gain. So that would be the 4-point checklist. But again, don't get too hugely caught up on end of financial year. I think there's a lot to play made of it, more than it probably should be.
So with all that being considered, what would you kind of point out as the key drivers of FY22 that you expect? And I'd really be interested to know if you're a bull or a bear going into the new financial year.
Yeah, so I mean, it's probably not new news to everyone, but I think the trajectory of interest rates are going to be really key going into FY22. So if you think about the market now, we're in pretty Goldilocks territory. You've got really strong economic growth, but you've got low interest rates, etc. So central banks are really supportive. So that's one point. I think so right now I think we're in a Goldilocks point of view. So I might just start sharing some screen if I can take over from that, Bella. So I've got some reference points to take out. I'm just going to move that over there and ensure that I'm sharing the right screen, everyone. So yeah, you should have a chart of the ASX 200 on your screen there. So what I just want to highlight just is around interest rates. So I don't think this can be too heavily emphasized. So if I think about interest rates, you've got to be thinking about bond yields, and the biggest most influential number that you look at is what's happening in the US 10-year bond yield, which is on the screen behind me. So obviously we've had a low point in bonds. So the US 10-year bond yield dropped and down to around 0.3%, which is historically low levels. We're now at 1.47%. So that's obviously a big rally from incredibly low levels. We peaked at about 1.77 and we come back from there. So when I talk about bond yields and interest rates, I sort of, you peg it to what's happening in the US 10-year, but also the relationship between the different duration of bonds, so shorter and longer dated bonds. And I'll get to that very shortly. So Bella, to answer your question, interest rates are the number one. I think number two is the COVID situation. So not the fact that we're lax in rolling out vaccinations or we're going into lockdowns, but whether or not we'll get a different strain morph that is not that can't be handled by the current vaccine as well as the current strains can be. So that would be the main things. But if I sit back and look at the economic backdrop that I just touched on, and I'll just give you some data points around this. So I look at global earnings, and global earnings are incredibly strong here. So, and that's why I'm remaining bullish the market. So if I look at earnings for global companies, they got down to 3.2 trillion in 2020. They dropped from about 4.2 down to about 3.2 trillion during COVID. They're now back up to the number here is 5.1 trillion. So we've had growth in global earnings of about 56% on a consensus basis this year. If I tie that back into the ASX 200, the trough in EPS for the index was 250. And that was down from a prior peak of about 345. We're now back up to 355. So I guess what I'm saying is the recovery is real. It's being supported by earnings. So that, the market where it is now, obviously we're having a bit of a soft session today, but the market where it is around 72.50, I think is warranted.
Okay, so let's talk a little bit more specific, sectors in the market and that sort of thing. So in the last 8 months, we've really seen this reflation trade come to light, banks that benefit, resources companies, that sort of thing. So moving into FY22, do you think there's still space for this area to grow, or is it getting too crowded and you're looking for opportunity elsewhere?
So the reflation trade got, if I go back and pull up the bond yield chart again, so the reflation trade is the fact that the economy is growing again, and that's being reflected in higher interest rates, etc. The outlook for inflation is increasing, so inflation is picking up, and we've seen that happen. So the inflation data has picked up pretty markedly. The best way to play that is through the resource sector, and that's been a really strong trade. And we've been on the reflation trade. We've been very bullish the resources and other sort of reflationary type sectors. So to me, right now, I think there's a hiccup in the reflation trade. It got really well owned and is now, you can see it in bond yields. And I think one of the key things that sort of triggered about being an over-owned trade is we had a really strong string of economic data, yet bond yields continue to track lower. So really well-owned trade. You look at something like BHP is probably your proxy on the Australian market to the resource sector, and that's run extremely hard on the back of a reflation trade. If I look at from a base metal point of view, so copper is sort of your broad indicator of economic strength. And you can see how obviously the reflation trade garnered a lot of attention. Some of the money is now coming out of the reflation trade. So the way we're playing it at the moment, we've been marginal sellers of resources. I don't think the trade is dead, but I think it's simply taking a breather here. And one of the other things that play into it, I'll get the right chart up here. That play into it is the US dollar. So I've got a quick view on the chart down the right here where we want to be overweight resources and overweight IT stocks. So right now, strength in the US dollar on the back of expectations around higher interest rates in the US are putting a cap on the reflation trade. And I think there's probably more to play out on the downside on the reflation trade.
Well, you mentioned inflation, and I just want to talk about that a little bit because it seems to be the hottest thing in markets right now. So a two-part question. First of all, when inflation starts to, pick up, a lot of people turn to gold as a hedge to that. So firstly, are you bullish gold? And second, a lot of people start now looking to crypto for the same purpose. So are you wary of that whole move towards crypto as well? So gold in the first instance, so there's a chart of gold up there. You can see it's trading just below 1,800 an ounce. So our positioning around gold, we have a position in, we've got gold in the portfolio. We own a reasonable position in Newcrest. Recent weakness has not been good. So I'm a little bit 50-50 right here on gold. I think it is a legitimate hedge around inflation, and I'm going to come back to Bitcoin in a second. It is a legitimate hedge around inflation. I think in the short term, what the US dollar is doing is probably more important for the gold trade. So right now, I think the US dollar is sort of mid-range. I would think, my view is that the US dollar goes up and tests that 94 region. And if it goes and tests that 94 region, then the gold price has further downside in the near term. So summing up my view, yes, I think it's a hedge against inflation, but I think in the near term it looks average. So I think it'll be lower in the near term, but I think over time it'll rise as those inflationary fears. Right now,
everyone thinks inflation is very transitory. And we're seeing that by the reduction in longer dated bond yields. But I think that will evolve over time. So short term, very cautious. I think gold will be lower in the short term. But I think in the medium to longer term longer term is pie in the sky sort of stuff. When you're thinking about gold, I think I think it will trade higher as inflation does pick up. So Bitcoin, it's a topic from a we run a newsletter, we write about things, we take questions from subscribers. It's one of the sort of hottest, not the hottest, but one of the frequently asked questions. So I've thought a lot about Bitcoin. So the bearish thesis on Bitcoin is that there's nothing, there's no substance to it. So there's nothing behind it. It's a creation. There's nothing there. There's no there's no cash flow. There's no assets, etc. So there's nothing there. But if you think about that, that's true with a lot of assets. So that's true with gold. That's true with things like art. There's no cash flows to be able to value an artwork. It's true with currencies. So where all these things derive their value from is being able to be used. So their legitimacy is dictated by whether or not they're accepted. So art's become an accepted form of value, and there's a scarcity of it, so it appreciates in value. Gold's the same. Gold's accepted. US currencies are accepted, etc. So to me, digital currencies, the future of them, and Bitcoin's one of those, will be around acceptance. And to me, I think it's getting more accepted. So that, to me, over time, it will become a legitimate, it will increase in legitimacy. I think it will take a while, and I don't know if it's Bitcoin or another cryptocurrency that's done, but whether or not, it's around people accepting it. And we've got a younger population that are accepting Bitcoin more than they accept gold. So over time, that will increase. So I think there is a true case to be made around cryptocurrencies. I've not owned it, Bella. I opened a crypto account this week, only simply because I talk about it a lot, and I hate talking about things theoretically. So you've got to, when you sharpen your view on something when you've got a position in it. And Bitcoin, to me, traded below 28,000. That's a clear technical level to be buying Bitcoin. So if you can't value something, what dictates its price is psychology, and psychology is shown in its purest form through price, and price is shown through charts, which is what I'm showing on the screen there. So to me, I think Bitcoin it's put in a nice technical low.
We got a question from Neville, who says, due to the fall in prices of gold mining stocks, is it appropriate to buy now as a part of a diversified portfolio, just going off that gold that we were talking about before?
Yeah, I think that's sensible. So in the short term, I'd be a little bit cautious, and I'd let the US dollar dictate when I was buying back into, going more heavily into gold stocks. So my roadmap here is, if the US dollar index, which is the US dollar against a basket of its trading partners, goes up to 94, I think you'll see that'll be the catalyst for a low in gold, and I'll be accumulating at that level. So that might correspond with gold nearer to 1,700 an ounce.
I want to move a little bit more to talk about growth, because we were discussing, the low bond yields. So with the talk of the rising interest rates, but with bond yields kind of going the other way, are you positioning with a bigger allocation to these high growth stocks, and specifically what type of growth stocks are you looking at the moment?
So I think one of the interesting things you made about bond yields, and I touched on it before, the relationship between the different timeframes of bond yields, different durations. So longer dated bond yields are ticking lower. So the easiest way to show that is through the US 30-year yield. So the US 30-year bond yield has come back. And if you think about a growth stocks are, you price those, they're longer duration earnings. So they're long duration assets. So they're saying, we're paying this price now. I know that it's not earning a lot now, but it's going to earn a lot in the future because of the growth rates they're printing. So how you price a growth stock is off longer dated bond yields. So when longer dated bond yields rise like they did, and this is when we saw sort of the big rout in growth related high PE, high growth stocks, was when longer dated bond yields were ripping higher relative to shorter dated bond yields. So that's where you see a steepening of the yield curve. Right now, we've obviously seen that pull back. If you think about banks just for a moment as well, so banks are, banks borrow short and lend long. So I'll bring up the 2-year yield here, because right now you're seeing the 30-year yield come back, so decline. But you're seeing the shorter dated bond yields tick up. So this is the US 2-year bond yield. The US bond yield in the 2-year, the shorter end of the curve, has really ticked up. It's almost doubled in a really short space of time. So that is a negative for reflation trade. That is a negative for the bank trade, but a positive for the growth trade, or more so that the decline in the longer dated bond yield is positive for the growth trade. A bank, as I said before, borrows short and lends long. So when short-term interest rates go up and long-term interest rates go down, that is a negative backdrop for banks, and that's that's a flattening of the yield curve. A steepening of the yield curve is positive for banks, and that's the backdrop they've got. So tying that back into growth stocks, Bella, the outlook for growth has really kicked up, and we've transitioned our portfolio very overweight the growth space at the moment.
Can you give us an example of a stock that you think is in that area?
Yeah, absolutely. So if I'll run through our. So if I look at, I'll look at the stocks that we're holding in our portfolio at the moment. Where have they gone? So if I look at our portfolio holdings in our this is our flagship growth portfolio. So the good, the bad, the ugly here. So we've obviously got positions that we're underwater on. We're up on most stocks. The portfolio is up around 30% this financial year, but we've got about, on our growth stocks, we've got about 7 positions in our growth portfolio out of 17. It's about 20% of our capital at the moment, but it's about 40% of our positions. So, Altium's probably an easy one to talk about because that's under takeover. It's done nicely for us. We did a podcast just before it got taken out, but that's one we bought, and I think around the $36 mark. And I'll go back and show you on the screen what Altium's doing. I think that is a growth stock that is. That speaks to everything why we like growth. The fact that they came and Autodesk came and gave Altium a really bullish bid. So they bid them 40% above where the stock price was trading at, and the fact that they blocked that bid or rebucked that bid so quickly, the embedded value in that in a long-term sense is really key. So, to me, that there's a very high chance of another bid coming for Altium. So that's a stock that we hold. We hold Megaport in the portfolio. So this has really, it's been a stock that's rallied 65% in the last 3 months. Shorts have gone from 8% in this stock down to 6% as they've started to show better growth numbers. So look, at the end of the day, growth stocks, you've got to have a really close handle on what the stock is doing and what the market cares about on that stock, because the market cares about different things on different stocks. So in the case of Megaport, they dropped near $10 because their growth rates were slowing. But as soon as they showed growth in ports and reoccurring revenue, then that stock really had a strong rally, and it's rallied 65%, amplified by the amount of shorts that are out there.
We got a few questions about Altium actually regarding this bid. So maybe did you want to spend a little bit of time talking about what that means for people that hold this stock and whether that's a good or a bad sign for them?
Yeah, certainly. So Altium is attracted a bid at $38.50. It's trading at $36.26 at the moment. So there's still sort of that $2 premium between the share price and the bid price. So Altium board has rejected the bid. They've been working with Autodesk for a long time, collaborating with them. They've obviously looked pretty intently under the hood of Altium. They like the strategic value of the Altium technology around printed circuit boards and the like. So, and basically, Autodesk, I think they've made 150 acquisitions over 10 years. They're not viewing this as a short-term play. This is a longer-term strategic play for them. So, Altium's management, who have got massive skin in the game, they're big equity holders in Altium. Were quick to say that the bid undervalues them, but they don't. They don't want to annoy the bidder because they work with them. But obviously, I think there's going to be a higher chance that another bid will come into place, whether that's from the existing bidder, private equity, or another trade buyer. So that's all bids have got risk in them. There's no doubt about that. But I think it shows the underlying value in that share price, in that company, I should say, relative to the share price.
So if we take a little bit of risk off the table, there's been a lot of talk about a potential correction coming up in the horizon. So is this, as we enter the new financial year, time for investors to become a little bit defensive, perhaps put a few more staple stocks into their portfolio?
So is it now time to be cautious? I don't think so. I think the economic backdrop that I've sort of spoke to earlier, I think the economy is accelerating, and that's feeding down into really strong earnings. If you think about, I'll put another chart up there called money supply, which is this is money, M2 money supply. This is the amount of money that's moving around the system, and I'll go a longer dated chart there to give you some insight around this. So you see what the GFC, the increase in money supply was in the system relative to what we've seen in COVID. There's been an unprecedented level of new money put in the system. Rates are low. The economic backdrop, I think, is really supportive. So no, I don't think it's time to be defensive. Am I cautious? The market, I think there's plenty of there's risks out there, but I think given the risks out there, and what concerns me is complacency. Complacency scares me. I think that's what, from an investor standpoint, you should be concerned about complacency. It's the adage of it's the bus that you don't see kills you is the one that kills you. So it's not the risks that we see in the markets at the moment that we should be concerned about. I'm concerned about interest rates, but that's a known, and we can keep a handle on that because we can see it every day. The virus morphing into different strains, that's probably something we can't see as easily every day. So that points more of a risk for me. So no, but each their own. Defensive. The way of approaching defensiveness is, in my view, is around having the right asset allocation structure, not just stocks. But I'm sure we can talk defensive stocks because there's plenty out there in the market.
Well, you're obviously quite a bull, but do you have maybe an example of a defensive stock that's in the portfolio now that you think you could explain to us why you think that's defensive? So
I'm a bull, but I liken it to, I'll give you a little analogy. We had Brad Fittler in the office just before State of Origin, and we're talking about how you win State of Origin games. And one of the things in his coaching camps, and when he brings the team into camp, he talks about, it's everything. It's all about everything he does is about trying to get players in the moment. So being completely in the moment. And he talks about a concept of playing eyes up footy. So you win an Origin game by being in the moment and playing what's in front of you. And that's sort of how I think going into FY22, we've got to be approaching the market. We've simply got to be playing what's in front of us. So right now, I think that all of the indicators are positive. I think the market is where it should be. Earnings are above where they were before. The market's above where it was before, but then interest rates are lower and liquidity is higher. So I guess that's why I'm more bullish, going into FY22. But I'll be playing eyes up footy every day, looking at things that, that may tweak that view. So, in terms of defensive stocks, we certainly have defensive stocks in the portfolio because we know that we can be wrong. I mean, you've got to, as an investor, you've got to understand. I've got a saying on my desk in the office, which I'm obviously not in the office at the moment, I'm at home, but saying know that you don't know. And that's the way you should approach investment. In my view, you can have, a lot of, you can make it, do a lot of digging and you can do a lot of research, etc. But ultimately, you should know that you don't know. One stock we've got, and they reported yesterday in the defensive space, is Metcash. If I'm thinking about a defensive position, I think about a few different things. So, defensives should be not overly cyclical in nature in terms of their earnings. So their earnings should be consistent and well known. So they shouldn't be at the vagary of commodity prices or, winning large contracts or, delivering on a piece of infrastructure or something like that. I think that's, a staple. That's why the supermarkets are such a staple in portfolios, and they're considered a defensive part of investors' portfolios. That said, I think the other part of being a defensive stock is around having not being overly expensive, because really expensive defensives in an environment that we're going into in FY22, where interest rates, inflation really could kick. It might not be transitory, and that may force the central banks globally to raise interest rates quicker than they ordinarily would, and that will have a bigger negative impact on high valuation stocks, even if they're defensive. So to me, Metcash is relative, has got a defensive earnings stream. It's relatively cheap, so it's insulated against a big macro headwind that could transpire in FY22 or further, and it's pays a good yield along the way. So that sort of provides a baseline of earnings in a portfolio. So that's one for me. But I'd call out Telstra. I hate being the cliche, and I haven't liked Telstra for a long time, but I think Telstra is a really defensive earnings stream that's got a lot of tailwinds that are now building in its favour after a prolonged period of having headwinds.
Well, I'm conscious of time, so maybe we can move on to selling 101 as we've labelled it. I'd be interested, could you provide us with a sort of case study on a stock that you've recently sold and walk us through the process of why you made the decision to sell and how you went about it?
I haven't prepared a case study, Bella, for you. I left uni a while ago, but I'll run you through the last three stocks, or three or four stocks that we've sold out of our growth portfolio. So we trimmed Whitehaven Coal. So Whitehaven Coal has obviously been a stock that has been had a checkered history. We actually bought this pretty poorly. We paid $1.78 for it from memory. We added to it $1.30, and we just trimmed it at $2.05, and we're continuing to hold it for further upside. The case I'd make here is that whenever you buy a stock and you sell a stock for stock specific reasons. So the reasons that you're selling a stock is going to be different for each stock that you actually sell. So in Whitehaven's case, we bought it because the share price had languished relative to the underlying commodity price. Commodity companies with a high degree of certainty track their underlying commodity pretty closely. Whitehaven Coal wasn't doing that because of operational reasons. So we bought it because of that disconnect with the commodity price. Being cognizant they had operational issues, and that's why there was a disconnect. We sold it. We trimmed it. Last week or so because they were going. They were due to provide an operational update, and I think there was risks around that. So we trimmed 2% out of a big 6% weighting, and we're going to let the rest ride. We've sold CBA, or trimmed CBA and NAB out of our portfolio recently. CBA we trimmed for all the reasons why we've gone harder in technology. So CBA had a phenomenal run in price. We were 60. We bought it below $60. We've sold it above $100. The macro backdrop that was driving CBA was the steepening of the yield curve. Higher, longer dated bond yields were really positive for it. That changed. It got stretched from a valuation point of view relative to its peers, and we wanted to reduce our overweight to banks to underweight the banks. So we trimmed a position in CBA as a result of that. NAB was the same, although from a relative valuation standpoint, a little bit less obvious than CBA. So I like the banks. And the other one was Ramsay Healthcare that we've sold out recently. We sold that to make room for a technology holding. So that was nothing against that business. It was simply a case of we believed in the shorter term relative gains could be, short-term relative performance could be enhanced by buying something in the technology space relative to Ramsay Healthcare.
One final question from me before we move on to questions from the viewers. Is selling a different process at the end of the financial year, and how do you think about it at this time?
So it's different for who you're managing money for. So we manage portfolios on a discretionary basis for individual, typically high net worth investors, and we have the luxury of being able to look at a tax situation and make changes in line with that situation. So yes, at an individual portfolio basis, yes. If I cast my eye over out to the funds that we manage for through Market Matters, then no, we're simply making decisions around performance. Our sole focus is around performance. They've got more investors in those by quantum, so we're not making changes based on an individual's circumstances around that. It's a general bucket. So yeah, again, each case is different. But if you're running your own portfolio like I am mine, I will make decisions at end of financial year that suit my individual tax position, and that's different for everyone.
Okay, so we might just open up the Q&A portion of the webinar now. So for everybody watching at home, make sure you submit your questions. I've got one from Shane here who says that he's interested in the lithium supply to batteries for the EV market. So what's the best strategy in terms of that? Is it looking at something like an ETF like ACDC, or is it to invest in a specific company? Yeah,
so we right now we don't have any lithium exposure. We've recently trimmed ORE or a Cobra. Again, we took profits on it. It run really hard in our emerging companies portfolio. I'm a big believer in the battery thematic moving forward. I think it's probably got very overheated. So if I look at something like an ORE as a stock that's traded up to its all-time highs, it's the point where Toyota bought in. So Toyota bought their largest shareholder. They bought a large chunk of ORE back at 744, which was it corresponds with the high. So I think if I'm more of a fan of buying individual stocks because I understand the metrics of the stocks. One stock I like in the space that I think is doing great things is IGO, Independence Group. They're aligning their business and what they mine with the battery thematic. So to me, they've sold out of their Tropicana gold project. I think that makes sense. So that's one that I like. In terms of when to buy it, I'm a buyer of pullbacks rather than a buyer of strength here. The ACDC, the ETF, so that has it's obviously had a phenomenal run. These are monthly charts that I'm putting up. I'll take that back to a weekly. But you can see it's had a phenomenal run. It's an ETF that I like. I've got nothing against the ETF. I think that's a really good way if you're wanting to get a thematic investment in your portfolio going through a cheap ETF.
We've got quite a popular question here, which says, what risk weight do you contribute to trade tensions or geopolitical tensions with China and the US in the near term, and how might it have impacts on the Australian economy and markets?
Yeah, it's hard to come up with something that I don't have a lot of insight into the China US trade relations. I don't feel like I can add a lot of value to that conversation. So, from an equity investment standpoint, I'm simply trying to find the best risk reward investments out there to put into our portfolio. So, to me, it's a left field thing that I can't add any value to. I'm conscious of it if I have thinking about a company that derives the bulk of their earnings from China. So that to me is something that I would consider. So it would be on a stock specific level, but from a a portfolio construction perspective, it wouldn't be a major influence, but I wouldn't be putting stocks that derive, if I'm Treasury Wine Estates, I'm pretty, I'm a little bit concerned around that, and because you can't model that. So you can't model a reaction coming out of China. If you look at, what happened, with the anti-IPO over in China, like there's some things like China you don't want to get on the wrong side of them is the context here, but that's a risk from an investment standpoint. So it's really hard to model is the short answer.
Well, speaking of companies that have probably not benefited from that, somebody's asked a question. Can you provide an update on a few of the stocks that have gone backwards recently, including A2 Milk and EML Payments?
Yep. So we own A2 Milk in our growth portfolio. We are down. We've got it from about $8. We bought it originally around 10, and we averaged it in the low fives. So a couple of things that have gone obviously here. So they've had inventory issues, they've had pricing issues that's led into pricing issues. So they've had a lot of discounting. Their end market, China's obviously had major short-term supply demand issues, and that's had a negative impact on A2. It was a well-owned stock. The market was very much long this a premier growth company, and it's unwound pretty markedly. To me, I think where the valuation sits now relative to the risks involved, I think it stacks up. I think it's the market's got really bearish it. We have a research relationship with UBS, and they have what they call an evidence lab, and they do a lot of channel checking. The early indications are that the channels are improving there. Discounting is drying up, volumes are starting to improve. So to me, it's one of our, I think we've got 3 stocks in that portfolio that are in the red, and I think that's one of them. It's been a bit of a not our best call, but I think there's better times ahead for A2 and EML. I mean, it's a bit of a binary outcome here. So obviously they've got the regulatory issues from the central bank in Ireland that have come out and said that they, they've got major anti-money laundering issues in their Irish business, in their European business that they recently bought. So my feeling around that is it's binary. So I don't have any insight in how the regulatory process will go. My gut feeling is that we've seen AML issues hit Australian companies. It's not terminal. The pricing of EML at $2.47 when it got down to that low, or even around the $3, is pricing a terminal outcome in their European business, which I think is overs. So to me, I think you see a lot of stocks get hit, particularly in this the smaller part of the market, really hard. Like Tyro got hit really hard on the back of issues with their terminals, etc. The first reaction from the market is generally an overreaction, and then sanity prevails. In this instance, would I be buying it for $3.50? Probably not. Would I buy it if it went back to $3? Probably.
Well, we've got one final question from Paul, who asks, do you see a basis of recovery in the service stream business?
Yeah, service stream. It's been a really weak last 12 months for service stream in a business that offered a lot too. So they're obviously involved in the telecommunications space, delivering projects in that the NBN was a positive for them. In the last little while, they've had some issues with contract wins and not winning contracts. They've also had labour issues. So similar to the mining services companies that have had pressure in terms of labour and the cost of labour and that impacting margins, they've also experienced that in their business. I think there is a better 12 months ahead of service stream than the last 12 months. They came out recently with a operational update. They reconfirmed earnings guidance. There wasn't a lot of new news in the announcement, but yeah, it's a cheap stock. It doesn't have any balance sheet risk at the moment. There is some concern that they're going to go out there and make acquisitions. So in that update, the last update they had, I think it was pretty, I don't know, I sort of came away with it thinking that they are, come acquisition, and that would be, I think, probably a negative in the short term if they were to obviously raise capital to make an acquisition. That would be the only caveat there. But I think the business will improve. I think the track record's good, and I think it gets better from here. So at 87 cents, it's probably getting whacked by tax loss selling. It got removed from the ASX top 200 this year. So if you're going to sell something, it makes sense to sell. It's no longer in the 200, and it's been down pretty markedly.
Well, I can see that we're out of time, so apologies to all those people that we didn't get to your questions, but we will aim to get them answered at some stage soon. But thank you very much, everybody, for joining us. Thanks, James. I really enjoyed chatting to you today.
Yeah, great. I see there's quite a few questions there, so feel free to jump on to Market Matters. You can ask some questions through there. You can take a trial. We do have a Q&A section. There's one on Gemworth and Lendlease and a few other Woodside and a few other stocks that we do cover there. So feel free to jump on and take a trial of that. But thanks for having me, Bella.
And thanks everybody else for joining, and to all the Livewire readers, keep an eye out for the recording of this webinar that will be up later. So thanks again, stay healthy and safe, and we really appreciate your time today.
Thanks, guys.